Hi there, Brock VandenBerg, President of TaliMar Financial and Fund Manager for TaliMar Income Fund I. Today, we're going to give our July 2024 presentation. In the presentation, we're going to talk about May investor figures and then talk about the June figures for loan origination and loan servicing. The reason why we're going back 2 months for investor relations is that we're finding as the fund gets larger and larger, the duration it takes to close out the books, the books for investor returns for the prior month, is getting pushed out about 25 days after that month. So for example, to close out June figures, we're going to be about 25 days into the next month. So in this case, July 25th. So that's why we're kind of going back 2 months on investor figures and discussing last month's figures for loan origination and loan servicing. So let's go ahead and get started. Topics to cover we're going to talk about. Number one, we'll start with our announcements. Second, we'll talk notable statistics. And again, give a brief overview of the fund for those that may have not invested yet and may want to learn more about the mortgage fund. We'll give a brief overview about the fund. And then we'll go into some fund statistics and updates about what happened in May and June. We'll give you a little market update about what the housing market is doing nationally throughout the state of California and in San Diego, and then respond to some of the common questions that we are receiving from investors. So real quick announcements. Excited to announce that I did attend the National Lending Expert Conference last month. The National Lending Expert Conference is a national conference. It was actually hosted in Los Angeles. It brings together all the hard money lenders nationally together, and an opportunity to network with other hard money lenders, talk to them about what's going on nationally. Also hear from some great speakers. We've heard from Gerasi. One of our legal counsel was speaking there. We heard from some of the larger vendors, so people that are doing loan servicing, that are doing construction draws, that type of stuff. We heard from them. And then we also were included in a round table. TaliMar Financial and myself was a speaker on one of the round tables about what to expect in the private lending business for private debt funds like ours. So it was a great opportunity to share some of my insights. Bullet point number 2, we added a new team member to the team, Jennifer Miller. We added her to the loan closing team. That essentially puts all of the pieces together now for the basis of our company. We have 2 loan originators. We have a loan processor and underwriter. We now have Jenny Miller in loan closing, and she's a great addition. She's been in escrow and title for over 20 years. Brings a lot more knowledge to the table than I ever had. She's excited because she's getting out of the escrow and title side and going to the lender side. So she's looking at each transaction from the flip side. So excited to have her on. And then we have a full-time loan servicing team member that helps us with managing our loan servicer, FCI, doing construction draws, doing payoff demands and whatnot. So, and then we have obviously Sarah Zybura from an operational standpoint that is kind of overseeing the day-to-day functions of the organization, giving me more time to continue to look to bring or to increase the size of the fund and kind of look more strategically about where we're going as the fund. Bullet point number 3, returned a 9.37% return to investors in May. That was another strong return. If many of you remember, in April we had a large amount of liquidity on our balance sheet, large number of payoffs, and we spent a good portion of late April and early May getting that money deployed. We were able to do that, but still returned a 9.37% return to investors. Keep in mind also that our target yield for the fund is at 9%, and I think year to date we're about 9.51%. So we're definitely exceeding what our target yield for the fund is. We funded 15 loans in June for a total of $13.61 million. Definitely by far the largest June in terms of deal flow that we saw. We're going to do some comparisons later in this video comparing prior Junes. And then also it's our second month where we exceeded 10 million in total loans funded, which is another great hurdle that we were able to accomplish. Fifth bullet point, we raised $4.58 million in new investor capital in June. I think that kind of that snowball effect of kind of starting small and that snowball kind of growing as it's rolling down the hill has really started to pick up steam for us, and we're attracting a lot more capital into the fund. Vast majority of these are referrals or people that are currently investing in trust deeds, and essentially finding that it's more and more difficult to find good individual trust deeds out there, especially as the market that had traditionally been funded by individual investors is kind of becoming more of a marketplace for institutional lenders like us to fund. So definitely we're seeing a lot of interest from investors to add funds to the mortgage fund. All right, so real quick, for those that are not invested in the fund or want to learn more about TaliMar Income Fund I, we are a debt fund. We're a 506c fund, so we are accreditation is required. I established the fund back in 2021, though the actual company itself was established back in 2008 when I was funding individual trust deeds myself. We'd grown to about 50 million on individual investors secured in individual loans when we made that transition into a mortgage fund back in January of 2021. Our focus with the fund is first position loans secured on residential, multifamily, and small balance commercial loans throughout the state of California, always in first position. Current loan portfolio right now, as of the end of June, we have 92 loans totaling 77.12 million. I think actually as of today, we're probably closer to 85 million now. Total loans funded within the fund, we've done 255 loans totaling roughly 175 million. But company-wide, since our first establishing the fund, we're up at 900, almost 1,000 loans at almost $500 million in total loans. Current year-to-date return as of the end of May, we're at 9.51%. And then at the end of May as well, we have 288 investors. I think this month we actually exceeded 300 investors, so that's a great hurdle to accomplish. All right, so let's talk about loan origination. As I had mentioned earlier in this video, we had a very strong month in June. So let's look at the numbers. We funded a total of 15 loans totaling 13.6 million. Again, that far exceeded any prior June of company history in terms of total loan volume. I'm excited. We brought on 2 loan originators, and it's really boosted the amount of deal volume that we're seeing. And what's great about this deal volume is it's what I consider higher level deal volume. So we've got more experienced borrowers that are coming to us looking for really stronger type projects. So, we're still doing our traditional fix and flip loans, our traditional kind of bridge loans, but we're seeing some more quasi ADU construction loans where borrowers buying a single family home and building maybe 3 or 4 additional units in the backyard. We're seeing a lot more of that. And what's nice about those is that, again, the borrowers typically are a little more sophisticated, putting strong budgets together, scopes of work, execution when it's time, throughout the duration of the loan. Average rate of the portfolio is about 10.67%. So we're still seeing interest rates creeping up, which is good as an investor. I think we're probably seeing kind of a ceiling of what we can charge for loans within the Southern California market. I know nationally people are talking about getting higher rates, but in Southern California, there is just so much capital chasing these deals. You kind of have that ceiling in rates around that 10.5 to 10.75. Average loan size is a little larger than what we have typically done in the past. I think our average loan size within the portfolio is around 800,000. But with home prices continuing to increase here in the Southern California market, we were for the first time above 1 million. Average loan to value ratio is at 64.44%, so slightly below kind of our target LTV ratio of around 65%. Average term is 12 months, right in line with the loan terms that I'm always interested in funding. I prefer shorter term loans. You're taking less interest rate risk. If rates continue to go up, at least I can refinance these loans out of the portfolio, and you minimize market risk. So if you see kind of a decline in values in real estate, at least I've got a maturity that I can work with that borrower to either pay down the loan to ensure that we're back in line with with loan to value ratio. So again, June was an incredible month. July is also setting up to be another incredible month. As I mentioned before, the June, we exceeded funding 10 million for 2 consecutive months. I anticipate doing that here in the 3rd month. So the demand is still there. A lot of investors ask, Brock, how much real demand is there out there in the marketplace, especially with home sales, the lack of inventory out there. The lack of inventory for the consumer doesn't really correlate with lack of inventory for investors. My investors are buying very different property types than what a consumer would be buying. The homes that they're buying are typically very dilapidated. You're not going to have an end consumer buying these properties. Secondarily, the value of the property to an investor is actually greater than an end consumer. End consumer isn't interested in building ADUs on a project. Investors are, so they're willing to pay a little extra to acquire that property. And honestly, that's why I think you're really seeing an increase in values in these urban markets like San Diego, Orange County, and LA. It's because you got investors that are buying up properties at a higher price point than what an end consumer would normally purchase that property for. So loan origination, what this chart shows is a comparison for prior years for June. So if you'll notice, we had 13.7 million for 2024. That's nearly double what we did in 2023, which 2023 was actually a slight decline from the prior year of 2022, where we did about 8.6 million. So still see a high amount of loan volume. I'm confident that we can continue to grow the investor base and still maintain the ability to invest in new loans. This is an example of a recent closing that we had. Actually, this is a post-rehab photos. Loan size was about $758,000. It was a fix and flip loan. So our borrower the intention was to acquire the property, rehab it, and sell it. And what we consider a fix and flip loan is we'll hold back a renovation reserve and disperse that reserve to the borrower over the course of the project. So that ensures, number one, that the borrower has funds to actually complete the project, but we're only dispersing funds once the borrower has completed certain milestones. So milestones on a renovation project, something like this, where maybe they're not building additional square footage, is once demolition is complete, once the rough framing, electrical, and plumbing are complete, once flooring is installed, once cabinets are installed, interior paint, those type of things, they can easily provide evidence to us that the work is done, and then we disperse those funds to the client. These types of projects usually take we underwrite them to 12 months, but average, you're looking at maybe 6 to 8 months is the average actual turn time of a loan. It's interesting. I look back when I started the company and I was doing individual trust deeds. And I got to tell you, that was one of the biggest complaints from my trust deed investors, is that when they invested in these fix and flip loans, they turned so quickly. So you only invested for 6, 7, 8 months, and then you're having to reinvest in a new trust deed. The MortgageFund platform allowed us to kind of create a more consistent approach for investors while still being able to take advantage of these great loans. And I got to tell you, from doing this for 15 years, the fix and flip loan is probably one of the best loans to be investing in. Borrowers renovating the property, they're improving the property. Their clear exit is to sell the property, and they'll do anything they can to get that property sold. And they're usually sophisticated in the sense that they understand how to make those payments, that they're going to be making payments. So for me, I like fix and flip loans. Now again, kind of some interesting tips on this one. This was a repeat client. About 50% of our deals are repeat clients. Fully renovated it, and was actually under contract within 60 days. So this was a quick flip. So congrats, team, for putting together another great loan. Let's talk loan servicing. So I always talk about loan origination, upfront underwriting, processing is only 50% of the game in our business. You can only underwrite so much to say, okay, this is a good loan. The other 50% is ensuring that you're managing your portfolio the best you can. So you want to make sure that you're notifying the borrowers if payments are late, making sure that the borrower is on track to get those payments on time. If maturities are coming up, making sure that you're notifying the borrower with plenty of time to negotiate either an extension or to pay off that loan, and then just work with the borrower on just day-to-day issues of the loan. People always ask, well, Brock, if you outsource your actual servicing to FCI, why is it that you have a full-time person for loan servicing? And I got to tell you, for those that actually invest in individual loans and use FCI, you really kind of have to stay on top of them to ensure that that they're processing everything in a timely manner. But in reality, most of the question, or the borrower is always coming back to us, the lender, with questions about the loan. So you always have to have someone available to them to answer those questions. So let's jump over to loan servicing. Currently in the loan portfolio, as of the end of June, we have 106 loans, totaling 73.68 million. Average loan size is right at 800,000, as I mentioned earlier. June, we saw average loan closing amount is north of 1 million, and that's just because of where values in San Diego are going. So average loan size, again, in the portfolio is around 800,000. The portfolio yield, so what this number reflects is the yield, the gross yield that the portfolio earns after the servicing fee, but before the fund administration fees. So these are the fees that our fund administrator charges us, is at 9.42%. So strong number. Interest income, so the gross interest income the fund earned in June was 481,000. Actually a slight dip from what we had in May, just as we're trying to, obviously we had a lot of liquidity on the portfolio, so just earning a little less income than we had in May. Non-performing loans were at 3, totaling 1.24 million, so below kind of our 2% number that we try to keep under. Every one of these loans have matured, so we're working with the borrower to figure out if they want to extend the loan or if they're going to go ahead and pay that loan off. What this chart is kind of gives you a 12-month window showing the total outstanding balance of the loan portfolio. So you can tell that we've essentially grown the portfolio by, let's say, about 50%. So we're sub 50 million in May 2023. May 2024 now we're mid or high 70 million. Easily manageable. Again, a big question is, Brock, how are you and the team managing the growth that you have? Well, number one, we rely heavily on third-party vendors. In this case, FCI Lender Services does the heavy lifting for us, collecting the payments, putting the statements together, assisting us with the payoff demands and whatnot. And we have a full-time servicer in-house team member that can assist us with any questions the borrower has. So well positioned to double the size of this mortgage fund with the current staff that we have on place. Talk about loan portfolio. What makes up the loan portfolio? There's been a really interesting adjustment over, I'd say, in 2024. And that is fix and flip loans have become a larger percentage of the entire portfolio. We were about 50% bridge, 50% fix and flip. But now with a lot of these ADU construction loans, we're starting to see a larger amount of the portfolio going towards the fix and flip loans. What does that mean? Well, it typically means that we're just dealing with more construction draws. Number two, you're kind of dealing, in terms of the underwrite is a slightly different than what we call our traditional bridge loan, where you're underwriting to current value. There's no construction reserve. The exit strategy isn't typically to sell in a bridge loan, usually to refinance. The borrower just needs a short-term loan to do something, to either acquire the property or do something. But with the fix and flip and construction loans, you have a holdback, construction holdback that you disperse to that client over the course of the project. We kind of discussed that on that recent deal that we talked about. All right, property types. Really, our focus remains on single family. Most of the loan requests that we get are SFR or multifamily. As you can tell, the vast majority here. Let's see if I can't put a little. Here we go. The vast majority of the loans that we're funding are single family homes. I like it. Yeah, there's usually smaller loans, but when you talk about probably the safest asset to be lending on or securing your capital on, that's going to be your single family home, especially here in the Southern California market. Rest of the portfolio is made up of retail, industrial, commercial, which, by the way, industrial is another great solid property type. I know it's kind of one of those property types people will try to stay away from, but the demand for industrial properties in urban Southern California markets is strong. Same as retail, as long as you've got the right retail location and tenants. Retail is another great property type to be securing debt on. Usually you can get a better LTV ratio, right around 50 to 55% on retail. And then I think we've got one office loan in the portfolio. All right, let's talk about the fund returns in general. So we ended May with $77.7 million in total investor capital. That was 286 investors. As I mentioned here in July, I think we've already exceeded 300 investors, so the fund is growing quickly. The target yield for the fund is at 9%, but year-to-date returns were at 9.51%. Total loans within that portfolio are 106 loans, totaling $77.7 million, with an average yield of those loans in the portfolio of 9.44%. Here we have a chart showing the investor capital in the fund. So again, we're up about 60-70% in terms of total investor capital. In May 2023, we were approximately 45 million, and now we're at 77 million. And the amount of capital that's flowing into the fund has increased considerably over, I'd say, over the last 6 months. So I think we did 4.5 million, as I mentioned earlier, in total investor capital. Our goal this month is to be around 3 to 3.5. I think we've already at 2 million, and it's only 10 days into July. So demand is there. Again, we're seeing a lot of repeat investors, so people either bringing more money into the fund in their existing accounts, or if they're using non-IRA accounts, they're moving some of their IRA money into the fund. And we're still fielding a lot of calls from trustee investors or people that are having trouble putting their money out in individual trustees, and finding that the mortgage fund is probably a better option if they're looking for more consistency, if they're looking for some tax advantages to the distributions, and the ability to reinvest and earn and earn interest on interest, so compounded interest. So those are kind of the three main reasons why a lot of trustee investors kind of make this shift over to individual or into a mortgage fund. So let's talk return comparisons. I always like to say, okay, we're talking about a fixed income investment, which is what our fund is, and how does that compare to other alternative investments? And big one that I always hear is like, Brock, you got that 10-year treasury. What can I earn in 10-year treasury? Well, right now you're about 4.25% on a 10-year treasury note. I think this actually, these numbers are a little old as well. I think you're now sub 4% on the 10-year treasury. Same thing with your S&P 500 bond index. People do a lot of comparison of all the returns that we're offering. Now, the interesting thing here, when you compare these two options, the 10-year treasury and S&P 500 bond, is that you're not dealing with changes in NAV or net asset value. So, when you invest in the S&P bond index, the value, that investment dollar, is constantly changing every single day. So, you could be earning a 4% return today, tomorrow, and the day after tomorrow, but that NAV, your investment dollar, continues to go up and down. So it's something to take into consideration. It's not always apples to apples when you compare our fund, where the NAV is going to stay at $1,000 or should stay at $1,000 a square foot or $1,000 a share versus some of these other alternative investments. All right, let's jump right into the market update. Let's go ahead and start with national housing. We're all seeing the housing stats. Value or home prices continue to climb year over year. I personally have, I question year over year numbers. I like to see stuff maybe every 6 months because, values have come up, have definitely increased over the last 12 months. But I think what you are seeing is an increase in number of homes that are listed on the market. You're starting to see an increase in price drops. I think people came out of the gate listing homes at probably inflated prices. And then, yeah, I mean, those are the two main items I always question when I look at a 12-month comparison. So currently nationally, median home price is at $438,000. That's about a 5% increase year over year. Number of homes sold actually increased from this time last year. And then the average 30-year mortgage rate is at 7.1%. So a lot of people are going out and saying, well, I think mortgage rates are going to come down. Yeah, I mean, possibly. I don't see any real reason right now the Fed needs to be decreasing or reducing the Fed funds rate, which typically has a direct correlation to what the mortgage rates are. We'll see, though. I think there's some discussion, maybe one rate drop. But right now, within the jobs numbers and strength of the economy and kind of even what you're seeing in the general stock market and home prices, there isn't a real need for right now the Fed to decrease interest rates. I think a lot of people think that because you've got an upcoming election that's going to drive the Fed to decrease interest rates. Maybe, maybe not. We shall see. Number of homes for sale right now, you've seen, I think that's a number that we should definitely keep our eye on. That's a 15% increase from this time last year. As I mentioned, you've seen a pretty considerable difference in number of homes for sale. Now, keep in also mind that you had all-time lows. I mean, we're coming off near zero homes were listed on the market. So any increase should be thought or considered with a grain of salt, okay? Newly home listeds up 10%. Days on market really haven't changed, which again was interesting. You would think that with more homes for sale, you should see a slight increase in the number of days the houses are on the market, but you haven't really seen a considerable difference. Number of homes sold above the list price. This number, again, is interesting. I would say that a lot of the homes that I see listed within the San Diego marketplace, I feel the values are a little inflated. That's why you're seeing days on market increase here in San Diego, and I think you're going to see that trend nationally. Home price drops have increased. Kind of goes in line with what I'm talking about. I think homeowners are starting to really understand that the value of their home isn't really what they listed it for, and they're having to reduce the price of their house. Now, what's kind of pushing that, or I think it's kind of creating a floor, is that people really don't need to sell. So, why am I going to decrease my price, even though it's not selling, if I don't really need to sell? So I think we're kind of stuck right now in that thought process. All right, let's look California. You probably all heard that California home prices just keep moving up. So right now we're just about to break 860,000. It's roughly a 10% increase from this time last year. Number of homes sold increased a nominal amount to 26,000. In median days on market, you're still at 26 days, which, if you're under 45 days, it's still a seller market. Number of homes for sale, a big jump. We saw a 20% increase. Again, we had near zero levels, so that percentage increase can be kind of like can be eye-opening. But if you were to look at 92,000, you're still at probably 50% of what historically the number of homes for sale in California are. Newly listed homes, you've seen a jump there. Month of supply, you've seen 2 months. Still a strong market. When you start to get into kind of high 3, low 4 months of supply, that's when things probably should stagnate in home prices. Homes sold above list price, 50%. Again, I think that number is going to come down. I think you're seeing homes sitting on the market a little longer, people having to take some price drops to get it sold, and so which is why you kind of see that slight increase in homes or home prices. Sale to list price, again, homes are selling for a little more than what's being listed for, but I guarantee you next month when I show you these numbers, I think you're going to see a decline. Let's look at San Diego. This is our backyard. I always like to present this. Median home price was at $976,000. Though, if you did see just recently, San Diego did surpass $1 million in the median sales price of homes. Now, those were single-family homes. I don't think that included attached units, but still, living in San Diego is very expensive if you want to buy a home. Number of homes sold. Imagine this: 919 homes sold This was for June numbers. That's like saying 0 homes sold. Okay, there's just nothing for sale. Median days on market at 14 days. That's, again, you might as well put 0 right there, because traditionally you'd see between 30 to 45 days. Sale to list price slightly above. The sale price is slightly above the list price. That number is going to go negative. That number, I'm seeing a lot more reductions in home prices, and that kind of is what you're going to start to see, I think, over the next quarter. All right, so real estate in the news. U.S. home prices hit all-time high, pushing pending sales down 5%. Don't know if those two items are correlated, but yes, home prices did hit an all-time high when looked at this time last year. I think you're going to see home values decline here just because you're starting to see an increase in the number of homes listed. I think that those homes that are listed are inflated in value, so homeowners, I think, are going to have to come in line or come back down to earth what they think they're going to really sell their home for. And home sales should stay static or increase slightly, just being because that there's going to be more homes for sale. But interest rates have not really impacted the value of homes nationally. So I don't think it's impacted prior to these numbers, and I don't think it's going to impact it considerably moving forward. All right, so let's talk discussion points. First off, interest rates and how do they impact the returns of the fund? This is probably one of the biggest or most common questions I get. Now, keep in mind that the way we price loans here at TaliMar is based upon the actual supply of capital our borrowers have. So the more hard money lenders you have out there that are putting more capital into the marketplace that we're competing with are going to cause me or going to force me to reduce the interest rates that I can charge. Those rates are not correlated directly to the Fed funds rate. Now, they're loosely correlated because some of my competition uses heavy or may use credit lines to fund their loans, and credit lines have a certain interest rate, and you got to be funding loans above the cost of your credit line, or you'll be underwater. So that kind of creates a floor to what you can charge on interest rates. Those are, I guess, kind of the most direct impact that I see to the Fed funds rate. But right now we are seeing a lot of capital continuing to move into the marketplace. Not only investors within our mortgage fund are moving into this investment option, but all the big investment banks and private equity funds are moving into this space, which is going to impact the interest rates that lenders can charge. We haven't seen a huge impact yet, but we're definitely watching this closely over the next quarter. ADU construction loan requests are probably our #1 loan request. For those that are not familiar with an ADU, accessory dwelling unit, essentially imagine taking a single family home and building apartment units in the backyard. I know it sounds crazy if you're not here in San Diego or Orange County or LA, even the Bay Area, but the supply of housing, the demand for housing and the lack of supply of available housing makes this investment option something that can be very profitable for investors. So they're buying these homes, they're renovating the homes, but then they're putting 3 or 4 rental units in the backyard and holding these as long-term rentals. It's very common in the cities. The municipalities are really pushing these types of projects. So we're seeing a lot of loan requests. And again, it's typically it's a sophisticated investor who probably were flipping homes in the past and now kind of have moved into this investment option. Third bullet point, recent acquisitions and capital infusions of national lenders. So national lenders are getting gobbled up. They're being purchased by some of the big investment banks because of the yields that this private debt space can return to investors. So these national lenders have presence obviously in most states, and so they're getting gobbled up. I think Bain Capital just bought one of the lenders here in Los Angeles, plus infused about $100 million into another lender. So it just goes to show you how much demand there is to invest in this fixed asset or fixed income investment. And then fourth, increase in loan maturity defaults. Absolutely. And it kind of correlates again with ADU construction projects. So anytime you start to fund any type of construction project, there are going to be delays. Usually they're related to either obtaining permits, which here in San Diego, as much as you hear about, expedited permits for ADUs, it's still taking 6, 9, 12 months to get permits to build these accessory dwelling units. So that's causing delays. Number two, construction delays. Not so much the cost anymore of the raw materials, that's kind of stabilized, but honestly, it's just manpower. Our borrowers cannot find contractors that are available to build out these projects, so it's causing delays. So we're getting a lot of calls for projects that are kind of mid-construction that are coming up on their maturities. They're needing some type of refinance to extend that loan, and we're seeing some extensions or a higher volume of extension requests within our loan portfolio. All right, so common questions we're getting. Number one is, how are you handling the growth? As I mentioned earlier, we just brought on a loan closer to fill that role, and it kind of fills out every main facet of our company. So from loan origination to loan processing and underwriting, loan closing, loan servicing, and investor relations. So they're the main components of a private debt fund. And now we have a team member to fill every one of those roles. Sarah in operations is doing a wonderful job of ensuring that everything is working smoothly, which has freed up my time to look kind of at bigger picture. Where is the industry growing? What can we do to enhance the level of deal flow that we have? And then managing, obviously, creating best practices for servicing a growing loan portfolio. Number two is, how liquid is the fund? Well, as I mentioned, as I tell investors, historically we've been able to return investor capital within 30 days, and actually quicker. But when we talk about liquidity of the fund, you always have to take into consideration one of the biggest risks of a mortgage fund like ours is some type of ancillary or outside impact, something that would impact the fund that would scare investors and result in a large number of withdrawal requests. And what you would have is essentially a run on the fund, or similar to what you would run on a bank. And in those cases, if that were the case, in a lot of cases, the performance of the fund isn't even being impacted. It's just something happened within the economy or the market or something that you just have a large number of investors requesting a withdrawal. In those cases, it's going to take longer to get your funds out. So if you're investing in the fund, yes, historically we've been able to get out 30 days, but don't put money in the fund that you're going to need to get out immediately to either make a home payment or do something with, because you might be caught up in needing to wait for that distribution to occur. How do I lose money in the fund? Well, the biggest way of losing money in the fund is, obviously the value of the real estate that are securing our portfolio goes below the outstanding balance of the loans, and you see a large number of loans default, and therefore the sale of those properties would not be sufficient to pay off all the loans. But I'll tell you that probably isn't the biggest or the way you lose money. Most ways you lose money in a mortgage fund is you have a large number of withdrawals. The fund manager at some point is then required to sell off its assets, some of these loans, even though they're performing, they may be performing well. The open market to sell loans at that point typically isn't strong, so you're having to take discounts in selling those loans to return investor capital, and that's really traditionally how investors lose money in a mortgage fund, because the fund manager is forced to sell loans just to recoup the money for the investors. So those are really the two ways that you lose money in a mortgage fund. What if a loan goes bad in the fund? Well, this is what's great about a mortgage fund is, number one, if you're investing in individual trustees and the loan that you've invested in it stops performing, borrower stops making payments, well, 100% of your income on that loan stops. However, in a mortgage fund, especially ours, where you've got 100 loans in the portfolio, in one loan stops performing, you still have 99 other loans that are still performing, paying you that monthly dividend. And so it's a more diversified approach to investing in individual mortgages. So, one loan should not significantly impact. I think the largest The largest loan we have in our portfolio is around 4.5% of the portfolio. We try to keep it sub 5%, so you don't have any one loan that is heavily weighted in the portfolio. And then can I invest retirement funds into the fund? The answer is yeah. So we've actually have been approved on the Schwab and Fidelity platforms. We're looking to get approved on some of the other larger custodial platforms so that you can invest your retirement funds in the mortgage fund. If you have questions about that, feel free to reach out to our investor relations team. We'd be more than happy to walk you through that. Promotions, right now we're offering that $250 referral bonus. So if you refer somebody and they just open an account, they don't necessarily need to invest, you can earn a $250 referral bonus. Just make sure when they submit their new account application that they place you on, put your name on that application, or we won't know to pay out that referral bonus. So that does it with our July update. As I mentioned, I'm very positive about the performance of the mortgage fund. Number two, I'm positive and excited about the deal flow that's coming in. We're seeing a lot of great loans with very strong borrowers. And yeah, so I think the opportunity continues to grow. We're heavily obviously focused here in the San Diego marketplace, but we're increasing our exposure into the Orange County, Los Angeles, and the Bay Area markets, all within the California though market. If you're interested to learn more about the mortgage fund, feel free to reach out to me. My contact information is there, or my investor relations team. If you have questions about the slideshow and the slide deck that I gave here, feel free to reach out to me as well. And one last note I forgot to mention in this slideshow is that we just wrapped up the audit. We got a clean audit. I will be posting that audit here within the next 2 weeks on the VeriVest portal, investor portal. So we'll go ahead and send an email on that announcement as well. Well, thank you for taking the time to watch the video. And again, if you have any questions, please feel free to reach out to me. Thank you very much.